Let's talk about the markets in 3 minutes and think a little more about what's driving that turnaround in sentiment. You make the point that China stocks are still negative. Hong Kong, as you say, making something of a recovery during session, actually entirely flat right now. Is it to do with some of the data we've had out of China? Is that what's, even if China is still negative, it's off earlier lows. So is that what's changing and improving sentiment as we go through the day, or are we just getting further away from the US Wall Street session?
I don't think we've been trading off anything logical or fundamental to start this week. I know that seems a bit harsh, but apart from maybe commodity prices, energy prices, I think this has just been about markets getting a bit exuberant into year-end, including on Greater China stocks. And really this year, it's about some of that quick positioning, getting cleaned out. So those weak positions, getting stopped out of the positions. The backdrop for me is more important. We're trading a Goldilocks narrative. We're trading a growth story of moderate growth, not too strong that we need to have more rate hikes, and not too cold. And yet, we're also trading this really, really powerful message from the Fed that they are going to ease policy, even though there's no concern in the labour market, even though there's no concern in the economy, because there's such a great disinflationary narrative. Now, it's unlikely, well, these Goldilocks environments never sustain ad infinitum. They always go wrong. At some point, either it turns out to be too hot or too cold, or basically prices get too frothy. But I see none of those risks as being nearby. So I think ultimately the direction of travel for assets over the next few weeks will be for stocks to gain. And for bond markets, maybe not to rally even further, but probably not to retrace too much. And if they do pull back, very slowly. So I think that really today the turnaround is more about we're starting to see more fundamental trading come into the market very slowly. I wouldn't want to read too much into it, rather than interpreting the negative trading the first sessions of the year as being too much.
OK, the memes almost create themselves, don't they, Mark? I can see Goldilocks with a bit of a hangover into the new year. That seems to be the picture you're creating for us. Let me ask you about what came out of the Fed minutes and if there was anything to grab onto there. Some people are focused on the references that were made to 6-month PCE inflation, for example. We saw stocks and yields both climb a little but then fall again. I don't know whether any of that mattered to you in the context of not full market participation right now.
Not massively. I have to say what I thought was funny this morning is no one had like radical takeaways from the minutes, but normally you get a consensus of what the interpretation was. Now that consensus can change over time, but almost immediately people seem to be quite binary in which way it kind of went on this. So reality, FOMC minutes were not a big driver for me.
OK, not a big driver on that front. Eurozone CPI, we're getting a picture of that building up. The North Rhine-Westphalia numbers from part of Germany, of course, not pushing against the dominant narrative so far.
Yeah, and I think there's more softness to come overall. I think the deflationary theme for Europe, for the world, but particularly for Europe, has more to play out in the coming months. I don't know anything particularly about the prints today, but I think that overall the bond market rally in Europe is still going to be supported for another couple of months at least, especially since the economy is soft.